18 Lessons About Money. The Psychology of Money. Categorizing all debt as bad is a simplistic view that ignores its function as a financial lever. You're conflating destructive debt with constructive debt. What specific type of debt increases your net worth? The distinction isn't the amount, but its application. Consumptive debt finances liabilities. Productive debt acquires assets that expand your capital base. One is a weight, the other is an engine. The wealthy don't avoid debt, they weaponize it with precise intent against appreciating assets. Number 1. Wealth is what you don't see. The principle is that true wealth is the unspent capital converted into income-producing assets. It's the money that didn't get spent on the visible signals of being rich. The common misapplication is that we equate wealth with high-visibility consumption, the luxury car, the branded watch. This performance of wealth is often funded by draining the asset column, creating a high-income, zero-net-worth reality. The strategic implementation is what the wealthy do. They measure progress by the growth of their private asset base, not their public lifestyle. Their capital is working silently in businesses, real estate, and securities, invisible to the public eye. The payoff is that this mindset redirects capital from depreciating liabilities to appreciating assets, fundamentally altering your net worth trajectory. Number 2. Control your time more than your portfolio. The principle here is that financial independence is not a number. It's the point where your asset-generated income covers your expenses, granting you full autonomy over your time. The misapplication is chasing marginal percentage gains in an investment portfolio while sacrificing 60-hour workweeks for a salary. You're optimizing for returns on capital while ignoring the cost of your own time. The strategic implementation is to structure your finances and career to maximize autonomy. This could mean building a business that operates without your daily presence, or constructing an investment portfolio designed for cash flow, not just appreciation. The payoff is the ultimate return on investment, the freedom to choose what you do with your time every day. Number 3. Optimize for enough, not for infinite. The principle is that the most powerful financial position is reaching a point of sufficiency, where more money does not significantly improve your quality of life or happiness. The misapplication is the relentless pursuit of more as a default, moving goalposts indefinitely. This traps you in a cycle of earning and spending without achieving the freedom you initially sought. The strategic implementation is to define the specific annual income required to fund your ideal life, free from financial anxiety. This becomes your primary financial target, a concrete number to engineer. The payoff is that achieving enough allows you to switch from a mindset of scarcity to one of abundance and optionality, where you work by choice, not necessity. Number 4. Compounding requires survival above all. The principle is that compounding only works with uninterrupted time. The single greatest threat to this process is a financial blow that forces you to liquidate assets at a loss. The misapplication is taking on excessive risk, using high leverage, or having inadequate cash reserves, betting everything on a single outcome. One major setback can erase a decade of gains. The strategic implementation is to prioritize financial durability. This means conservative debt levels, an emergency fund, and a diversified asset base. The goal is to remain in the game under a wide range of economic conditions. The payoff is that by ensuring you can withstand downturns, you guarantee your capital stays invested long enough for compounding to transform it. Number 5. Your personal experience is not the market. The principle is that your individual financial journey represents a tiny, statistically insignificant sample size of the broader economy. Basing long-term strategy on short-term personal experience is a critical error. The misapplication sounds like this: I bought tech stocks in '99 and lost everything, so the stock market is gambling. Or, my house doubled in value, so real estate is a sure thing. This is narrative over data. The strategic implementation is to base your investment theses on decades of historical data and probabilistic outcomes, not your personal wins or losses. Detach your ego from your anecdotal evidence. The payoff is that this objective perspective prevents you from abandoning a sound strategy based on a limited personal experience. Number 6. Room for error is a strategic asset. The principle is that a margin of safety in investing, business, and personal finance is not conservative. It is the strategic buffer that allows you to take calculated risks and absorb unexpected shocks without system failure. The misapplication is operating at 100% capacity, with every dollar allocated and no slack in the system. A single missed paycheck or market dip becomes a crisis. The strategic implementation is to always maintain a buffer. This means holding cash beyond your calculated expenses, borrowing less than the maximum available, and assuming your investment returns will be lower than historical averages. The payoff is that this margin gives you the psychological and financial stability to make rational decisions during volatility. Number 7. Freedom is the ultimate dividend. The principle is that the primary return you should engineer from your assets is not just cash flow, but increased personal and professional autonomy. The misapplication is chasing the highest yielding dividend stock or the highest interest rate, often taking on unacceptable risk for a few extra points of return, which can compromise your long-term stability. The strategic implementation is to evaluate every investment and career move through the lens of freedom. Does this increase my options? Does it give me more control over my time? Does it reduce my financial obligations? The payoff is that you build a life by design, where your assets serve your life, not the other way around. Number 8. Define the game you're actually playing. The principle is that every financial decision is part of a specific game with its own rules. Speculation versus investment, trading versus owning, short-term versus long-term. Consistent success requires knowing which game you are in. The misapplication is confusing a long-term buy-and-hold investment strategy with short-term speculation. Using a trader's mindset for a retirement portfolio or an investor's patience for a tactical bet. The strategic implementation is that before committing capital, write down the rules of your game, your time horizon, your measure of success, and your clear exit conditions. This creates an objective framework for your decisions. The payoff is that this clarity prevents emotional reactions to market noise. Number 9. Pessimism sounds smarter but pays less. The principle is that financial media and commentary are dominated by pessimism because it captures attention and sounds prudent. However, long-term economic growth trends have consistently rewarded optimistic investors. The misapplication is paralyzing your capital on the sidelines, waiting for the perfect risk-free moment to invest, which never arrives. You miss the compounding growth of entire market cycles. The strategic implementation is to acknowledge risks, but base your core strategy on the historical tendency of economies and innovation to grow over the long run. Tune out the perpetual doom cycle. The payoff is that staying invested through periods of uncertainty is what allows you to capture the handful of days each decade that drive the majority of market returns. 10. Long-term plans require short-term flexibility. The principle is that a rigid 30-year plan will break. A flexible system, built around core principles, can adapt to unexpected opportunities and setbacks without failing. The misapplication is creating a detailed linear financial plan and treating any deviation as a failure. This leads to forcing bad decisions just to stick to the original script. The strategic implementation is to set a clear long-term vision, your enough number, your target asset allocation, but maintain tactical flexibility in how you get there. Be willing to adjust your methods as conditions change. The payoff is that you become anti-fragile, able to benefit from volatility and new information. Number 11. Past performance stories hide the turbulence. The principle is that historical returns are often presented as smooth, upward-sloping lines, erasing the extreme volatility, drawdowns, and psychological stress that occurred in real time. The misapplication is looking at a 10-year chart of a successful company and assuming the path to wealth was obvious and easy. This underestimates the resolve required to hold during 50% declines. The strategic implementation is that when studying past successes, focus on the maximum drawdowns and the periods of doubt. Understand the volatility you are signing up for, not just the average annual return. The payoff is that you enter investments with realistic expectations, mentally prepared for the turbulence. Number 12. Reasonable beats rational in the real world. The principle is that a theoretically rational financial model that you cannot stick with is useless. A reasonable strategy that accounts for human behavior and emotion is sustainable and therefore more effective. The misapplication is designing a hyper-aggressive 100% equities investment portfolio that looks great on paper, but that will cause you to sell everything during the first 20% market correction. The strategic implementation is to choose a financial plan that you can execute consistently, even if it's not mathematically optimal. This accounts for your own risk tolerance and psychology. The payoff is that a slightly suboptimal plan you follow for 30 years will outperform the perfect plan you abandon in 3. Number 13. Savings is a call option on opportunity. The principle is that capital held in savings is not idle. It is a paid-for option to acquire assets when they are cheap and opportunities arise. The misapplication is viewing cash as a drag on returns during bull markets, minimizing it to near zero. This leaves you with no ammunition during market downturns when the best deals appear. The strategic implementation is to maintain a strategic cash reserve specifically for opportunistic deployment. This is separate from your emergency fund. It is your dry powder. The payoff is that when others are forced to sell, you have the liquidity to act. This turns market volatility from a threat into an advantage. Number 14. Moats matter more than momentary peaks. The principle is that the value of a business or asset is determined by its long-term competitive advantages, its moat, not its current quarterly earnings or price. The misapplication is chasing hot stocks or trends based on short-term momentum, without analyzing the underlying business's durability and ability to fend off competition. The strategic implementation is to invest in assets protected by durable moats, strong brands, network effects, patents, or low-cost production. These are the businesses that can withstand competition and economic cycles. The payoff is that you build a portfolio of resilient assets that generate wealth for decades. Number 15. The goal is resilience, not just returns. The principle is that a robust financial system can withstand shocks and continue to function. Chasing maximum returns often introduces catastrophic single points of failure. The misapplication is concentrating a portfolio in a single, high-return asset class, sector, or even a single stock, betting everything on its continued success. The strategic implementation is to build a portfolio and income streams that are non-correlated. If one part of your system is under stress, others can support it. Diversification is not just for returns, but for survival. The payoff is that you sleep well during economic crises, knowing your overall financial health is not dependent on any single outcome. Number 16. Your behavior is the ultimate asset. The principle is that your ability to remain disciplined, patient, and rational during periods of extreme greed and fear is the most valuable asset you possess. It cannot be easily replicated. The misapplication is having a brilliant investment strategy, but abandoning it at the first sign of market stress or the allure of a speculative bubble. The strategic implementation is to invest as much in cultivating your financial temperament as you do in researching assets. This means creating systems, like automatic investing, that limit your ability to make emotionally driven decisions. The payoff is that a person with average intelligence and exceptional behavior will consistently outperform a genius with poor emotional control. Number 17. Manage your downside. The upside follows. The principle is to focus intensely on what you can lose in any financial decision. By systematically limiting your potential losses, you ensure you stay in the game, allowing the power of compounding to work on your winners. The misapplication is focusing only on the potential upside of an investment. This could 10x, while ignoring the realistic probability and consequence of a 100% loss. The strategic implementation is that before any major financial commitment, ask, what is the worst-case scenario? Is it survivable? How can I structure this to limit my downside? Use stop losses, position sizing, and non-recourse debt. The payoff is that you avoid catastrophic losses that permanently impair your capital. Number 18. The story you tell yourself is everything. The principle is that your financial results are ultimately a reflection of your identity and the internal narrative you hold about money, risk, and your own capability. The misapplication is holding a scarcity mindset. I'm bad with money, wealth is for others, or a get-rich-quick narrative that leads to reckless, lottery ticket-style decisions. The strategic implementation is to consciously craft a strategic empowered narrative. I am a builder of durable assets. I am a rational capital allocator. Your actions will naturally align to confirm this identity. The payoff is that you rewrite your financial operating system at the deepest level. Bonus point: define your specific number for enough. This is the most important strategic exercise. Enough is not a vague concept. It is a precise, calculated number. It is your annual living expenses multiplied by 25, that's the 4% rule, or your target annual passive income. This number is your financial finish line. It is the point where you win your own game and can stop competing for status. Knowing this number with precision focuses all your resources and eliminates the noise of pointless accumulation. This is the foundation of true financial freedom. Those are 18 frameworks. Their power multiplies when you combine them. This is the psychology of money, the operating system that runs in the background of every wealthy individual. If you applied even one of these points to your financial strategy, let me know. In the comments below, write the phrase asset builder. This helps me see who is here to apply these frameworks, not just consume content. If this delivered value, like the video. It tells the YouTube algorithm that this is substantive content, helping us reach more strategic operators like you. Subscribe to Caifu for daily tactical frameworks. Share this with one person in your network who is ready for this conversation. There's another video on screen now about constructing your personal financial system. I'll see you in the next one.